Welcome to Bar Chart's series of webinars designed to help you and educate you in a variety of market concepts, inform you of features and tools Bar Chart provides related to these concepts, and finally, to give you some trader's insight to help you make a more informed investment decision. Today's subject, Commitment of Traders Report, and what you need to know. Now, many of you are aware that my professional background stems from the future sides of the markets. And when I first was starting out as a junior trader, an old dinosaur trader came up to me and once told me that he could trade any commodity with just 3 pieces of information: daily volume, open interest, and the Commitment of Traders Report. Now, what I learned from this trader turned out to be true. And now I'm that old dinosaur. And today I want to prove to you guys that there is a lot of information contained inside the Commitment of Traders Report. And adding this skill to decipher its meanings will make you a better trader. Now, before we get to that, please welcome my partner and our moderator, Bar Chart's Project Director, Gene Baker. Hello, Gene.
Good afternoon, John. How are you doing?
I'm doing fine. And how's things in the windy city today?
It's getting rainy right now, and we're gonna, guess, have a little bit of a winter storm coming in here. So hold on tight.
Hold on tight.
All right.
Get those galoshes out, right?
Right.
All right, you ready to get started?
Absolutely.
Okay, great. So always remember that today's session is for educational purposes only, and decisions to buy, sell, hold, or trade securities, commodities, or other investments involve risk and best made on the basis on the advice of qualified financial professionals. Futures trading is not for everyone. In futures trading, you can lose more than your original principal. And under no circumstances shall we be liable for any losses or damage you or anyone else incurs as a result of any trading or investment activity that you or anyone else engages in based on information or material you receive through Bar Chart. Okay. So before we get to the Commitment of Traders Report, what I need to do is kind of build a base level of knowledge with you folks. So first, I'm going to assume that most of you understand or have a knowledge that volume is a record of transactions between buyers and sellers, and volume confirms price. We've talked about that in many of our other sessions. But what is open interest, and what is its importance as it relates to our markets, and more importantly, how it relates to the Commitment of Traders Report? So open interest is the number of contracts market participants hold open and have yet to close. The greater the amount of open interest, the greater the amount of money that has been committed to risk. What I need you to understand or grasp is that it takes 2 parties to create open interest, a buyer and a seller. So if I look to open a long position, buy, as you open a short position, sell, together we create one open interest. If I buy to open and you sell to close, then all I'm doing is taking your open interest. And open interest will remain the same. So changes in open interest, rising or falling, is a sentiment indicator and a determinant of how strong or weak our trends are. So if I have a trend, an uptrend, and I see my open interest is rising, then that uptrend is likely to continue. If I am in an uptrend and my open interest is decreasing, then I'm likely to see that uptrend reverse. If I'm in a downtrend and my open interest is increasing, then that downtrend is likely to continue. If I'm in a downtrend and my open interest is decreasing, then that downtrend is likely to reverse. So you can see from this slide, there is a strong relationship between trend and open interest. So as we look at the Commitment of Traders report, I want you to be aware of that some market participants' positions might grow opposite of price trends. But this is still interpreted as a strengthening trend because of rising open interest. But when open interest positions reaches a historic level or an elevated level, then this could be a warning sign to our trend. So what exactly is the Commitment of Traders report, or sometimes referred to as the COT? Well, it's a report that is put out by the CFTC, the Futures Trading Commission, the regulatory body of futures markets, and it contains a historical record of all the futures, U.S. futures markets, and it breaks down open interest into position types and market participants. The position types that we will see will be longs and shorts and something called spreads. Now, unfortunately, we don't have enough time today to talk about spreads. We'll use that, maybe we'll do that in advance or sometime in the future. Maybe that might actually pop up on our YouTube channel. I'm not promising that, but that's what, maybe we'll address that. Also, participant types, commercials and non-commercials. So a couple things we need to know. First, the distinction between commercials and non-commercials. So commercials are commonly referred to as hedgers, and these are the companies or traders that deal in the actual commodity or futures market as part of doing their business. And their main purpose of using futures contracts is to lay risk off. And this is in order to them to facilitate their economic activity. Commercials give us a clue when prices are relatively too high or relatively too low, because remember, they are in the business. They know that business. Now, commercials are exempt from position limits. Non-commercials are our speculators, and their main purpose is to take risk on in order to profit from price action. These traders tend to be trend followers or trend riders. In other words, the market participants that drives price from relatively low levels to relatively high uptrends, or relatively high to relatively low downtrends. Now, large speculators are traders whose trading levels are high enough that they must report to the CFTC. And non-commercials or speculators do have position limits. So the next thing that we need to know is that the report, the Commitment of Traders report, is reflective of positions on Tuesday's close of business. But the report itself is not released until the close of business on Friday. So it's not instantaneous, it's not updated daily, and it's not a timing tool. What is it? It's a tool that allows us to decipher who and what market participants are influencing our trends. All right, so on this page here, we can see the Commitment of Traders. Just a little bit below here, there's a little bit of that terminology that we just talked about: open interest, reportable positions, commercials and non-commercials. And when we dig a little bit deeper, we'll look at the different types of Commitment of Traders reports, disaggregated and traders of financial futures, and there are some definitions here about the different market participants. All right, So, as I said, the Commitment of Traders report, there is actually 3 types of reports. The first one is called the legacy report. Now, what the legacy report does is it puts our market participants into these 2 large buckets, commercials and non-commercials. And you can see that here in our tab. We'll look at the legacy. Our commercials are hedgers, and our non-commercials are speculators. Now, sometimes you will also see small speculators in here. They'll separate the 2 speculators, but we're really talking about these 2 major groups. If I look at the desegregated report, well, the desegregated report takes the legacy report and breaks it down, our commercials and non-commercials, into some smaller categories. Now, the desegregated report is for our physical commodities, energies, grains, livestock, meats, softs. And we have 4 different categories. Our producers, merchants, processors, users. These are our commercials, those that are in the know, those that use futures, use these products or these commodities in their day-to-day business. And I like to call them our makers and our takers. We have swap dealers. Now, a swap dealer is classified as a commercial trader because their customers use them to lay risk off, and they use futures markets to mitigate that risk. But I want you to realize that some swap dealers' customers can be speculators. Oops, money managers. Money managers are our speculators, hedge funds, leverage funds, and then our other reportables. Now, this is kind of a catch-all basket. It just basically puts those that don't fall in these first 3 categories. And usually what we're really talking about here is our retail traders. Under the financial or traders of financial futures report, now this one is for financial futures. In other words, currencies, interest rates, and our indexes. And they have 4 different subcategories. Now, in today's modern markets, this is a lot more convoluted, these categories. So for instance, if I talked about, let's say, Goldman Sachs, large Wall Street bank, they would be classified as a dealer intermediary, but also they could be an asset manager or an institutional trader. They could also be a leveraged fund trader. So the lines are a little bit blurred, but again, if you wanted to get deep into the weeds, we do have those definitions. And again, like I said, most dealer intermediaries are our large Wall Street type banks. They represent what is called the sell side. The asset managers, leverage funds, and other reporters are on what we call the buy side. Okay, but we'll look at how we can use this to our benefit. All right, so let's do this. How can I apply the Commitment of Traders report to our trading analysis? So let's look at first 2 ways. The first way is we're going to look for extreme positions between our prominent traders, our commercials and non-commercials, when they reach historical high long positions or historical high short positions. Now, this will be a potential signal that our trend is about to change. The other thing we're going to look for is inflection points, where one of these large traders moves from being long to short, or long open interest to short open interest, or short open interest to long open interest. And this can be an indication of a new trend. So let's go back to our legacy report. And before we break this down, the next thing you need to know with the Commitment of Traders report is that the report designates long positions with a positive number. So if we see here on February 1st, for our wheat commercials, our hedgers, their position was 5,100, a positive number, meaning that they were long 5,100 contracts. And short positions are registered or designated as negative numbers. So if we look on January 25th, our commercial hedgers for wheat were short negative 32.25. Now, from February 1st to February 8th, we can see that our commercial traders increased their open interest, their long position, about 2,800 contracts. One of the nice features that bar chart does for us is it gives us these two colored boxes. And notice that the light blue one says that the prior period value was negative. That is one of the things that we want to start looking for. When one of these large participants moves from a negative short position to a positive position. And you can see that on February 1st, we have a blue box, which is telling us that the previous position was negative. I moved from negative to positive. I moved from short to long. If we look at the light purple box, it says that the prior period was positive. In other words, we went from long to short. And you can see here, negative 32.25. And the prior period, we were positive 51.60. In other words, they went from a long position to a short position. Okay. So now let's kind of look at what's happened here over the last 5 weeks. So on January 11th, our large commercial traders were long 12,000 contracts. And from January 11th to January 25th, they went from being long to short. Now, first, let's think about this process. How does a long close out his position? By selling. How does a short add to his position? By selling. So we can see that from January 11th to January 25th, our large commercial traders in wheat were selling the market. And then from January 25th to February 8th, they went from being short to being long. How does a short close his position? They buy. How does a long add to his position? They buy. So from January 25th to February 8th, we see that our large commercial traders were buying the market. Now, if we were trying to imagine what price was happening during this 5-week period, we might make the assumption that from January 11th to January 25th, as our large commercials are selling, prices might be going down. And that from January 25th to February 28th, prices might have been going up. But if we look at the chart, now the chart that I'm going to pull up here is a weekly chart, 3 years weekly chart. I'm going to granulate this. I'm going to break it down so we can see the weeks a little bit more defined. So we said around January 11th, there's January 11th. And if you look at the box up in the right-hand corner there, it says COT, parentheses C's, that's our commercials. They were long 12,100 contracts. Again, look at the box at the bottom. It says that the red line representing our commercial traders. And then here's January 25th, where we said that our commercials went from being long to being short. And we assumed that prices would be going down. But prices didn't go down. Prices went up. So this is what we will see a lot of times in our commitment of traders report, that our large commercial traders' positions will be opposite to price action. But what is important here for us is that when their positions get large, either large long or large short, that is an indication to us that they're telling us that prices are relatively too cheap. Or in this case, they went from being long to short. They're now telling us that prices are too expensive. And then as prices fell, what did they do? They bought back. They got long again because prices are relatively cheap. So one of the ways we can look at the commitment as traders report as we look at our commercial traders, we want to find out when their positions get to extremes or when they move from one long position to a short position, because that will tell us that either prices are too low, they're getting long, or prices are too high, they're getting short. So let's go to the disaggregated report. And again, we have 4 different categories. And our first category is our producers, merchants, processors, users. And another feature that bar chart does for us is it shows us 52-week highs and 52-week low positions. Again, a positive long position will give us a high 52-week number. A large short position will give us a low 52-week number. So we can see on soybean meal that our producers, merchants, processors, users, our commercials have now the lowest value in terms of a position. In other words, the highest short position they've had in the last 52 weeks. So if we take the knowledge we just gained from the wheat example and we went to the soybean meal market, knowing that our commercials have the largest short position that they've had in the last 52 weeks, what do we think we're going to see in price? Are we going to see price at a low value? No. We're going to see prices at a high value because our commercials are telling us that these prices are at the highest that they've seen in a long period of time and that they're shorting this market. Now notice that in this next week, this week that is going on now, prices have fallen. So when our commercials and other market participants' positions get to extreme values, this is a warning sign that our trend is about to end. All right, so let me go back to the grains markets. And let's look at soybeans. We just looked at soybean meal. And so we can see here for our producers, merchants, processors, and users, our commercial traders, they've had a short position, right? 236, 250, 254, 260. So their short positioning is growing, rising open interest. So that is a sign of a strengthening trend. So whatever price action we see, we're going to see a strong trend. Now, have they reached a 52-week low? Not yet. Is there room for that trend to go? Probably. If I look at my speculators in soybeans, notice that their position, their open interest position, has been a positive number. In other words, they're long and they have been increasing their position as well. A sign of a strengthening trend. And here we see on our disaggregated report, we see that rising open interest, both on the long side by our blue line, our speculators, and rising short interests by our commercials is a sign of a strengthening trend. So what's another way we can use the commitment of traders report? Remember, it's not a timing tool. But what we've discovered here is that we have a very strong trend. So what we can do is we can use the commitment of traders report to increase our probabilities. Knowing that I see both of my market participants increasing their positions, putting more money to risk, strengthening this trend, then the probability is that I'm only going to look at strategies that take on the bull or uptrend strategy. So let's granulate this chart. And again, you can see our rising open interest of our two market participants as our market is strengthening. So let me do this just because I want to make sure you guys can see what I'm talking about. So this is just the soybean market. I've just went to a different chart, a candlestick chart, because I know a lot of folks like to see candlestick charts. So again, what I'm saying is now that I've discovered that I have a strengthened trend as I see this probability increase, then I'm going to only look for buying opportunities. And it depends on your strategy. Maybe you will look for buying dips. Maybe you're looking for breakouts. But you can see, there's a couple good examples. Those of you who know what supply and demand pictures look like. Here's a rally-based rally where price on a down day gave us an opportunity to go long, or where price re-engages our trend. That's usually a good area to look to take on a long position. And then here we have a little bit of a bull flag, right? Where we could take a breakout trade. So two different types of strategies, waiting for the dip to buy the dip or looking for those breakout opportunities. But I'm waiting for the probability of a long trade. So let me go to energies, and I want to go to natural gas because there's a couple of cool things what's going on in natural gas. So first of all, let me pull that up. Let me go to the chart here first. So when you're on an individual contract specific market, you don't have to go through the commitment of traders page. If you scroll down here, you do see more of a summary report of our commitment of traders report, and you can go to the chart. And what's nice about this one is it gives you both the legacy and the disaggregated report along with your chart. So sometimes I get asked a question, and the question kind of goes like this, and it doesn't matter what market I'm looking at. Is there one group of traders that I should be concentrating on, or the ones that are going to influence price greater? Now, every market is different, and every market participant does play a part in price. So what I want you to look for is, does that group, I don't know what group it will be, but does a change in their position, their open interest position, have an effect on price? Now, normally a swap dealer in a lot of our markets does not have a lot of an influence on price. They're kind of neutral to the market. But let's look at this natural gas example. And here we see a different story than we saw in the wheat market. Here we're going to discover is that our commercials were the driving factor behind this price trend. So first, our legacy report. Remember, our red line represents down there on the bottom our commercials. And what did I say to you? we want to start looking for these inflection points when our large trader groups move from one position to another. And you can see that our commercial traders right about here went from being short, a negative number, to start being long. And notice that price started to trending higher. And so when our commercials are behind our trend, it's time for us to take notice of that. And that is very, very significant. If I look at the disaggregated report, notice that it's our swap dealers here, the ones that are driving natural gas prices up. So a lot of folks might not know the natural gas market as I do, but a lot of swap dealers in the natural gas market represent other companies that either can't trade futures markets or they use derivatives, over-the-counter contracts, and then the swap dealer uses the futures market to lay that risk off. And so one of the customers that a lot of swap dealers deal with are utilities. And so what we really saw here in this price appreciation as swap dealers were hedging but going long natural gas is that a lot of utilities knew that there was going to be a problem or a shortage of natural gas going into the winter season, and they were hedging that position. But notice also, again, when our positions get to extremes or historical levels, that's a sign that our trend might be coming to an end. And you can see that once we reach that historical high, a high that we hadn't seen in a long period of time, that would be a sign that that trend is coming to an end. Now notice though, the last time we had this historical high level, long position, was after the market had fallen. So we're seeing two different trends, but the result is still the same. When the position gets high, that's usually a sign that we're going to see a change in trend. So here we see they were adding, getting long, and the trend was going down, a sign that prices are relatively too cheap. Here they've gotten really long, and they've gotten to a point of saturation that now it's telling us that our trend might be coming to an end. So let's look at what's happening in the short term here. Notice that we do see another price spike, another price rally. But if we look at our legacy report, what are our two major positions doing? Now they're relatively the same, but they are decreasing. Falling open interest, weakened trend. So this price action is not on strength. This price action is on weakness. If we look at our disaggregated report, notice that our commercials here have gone from a short position, down here about 130,000 contracts, to a lesser short position, about 70,000 contracts. How does a short close their position? By buying. So we see a price rally on closing of a position. In other words, a weakened trend. And that when price reached an area that commercials have already kind of told us is an extreme value, that's where price failed and fell back down. Now in the very micro, we do see that prices are stabilizing and starting to trend higher on the backs of first short covering by our speculators, but now they're starting to add or going long. So this could be the driver of our next trend as our speculators are starting to get long. But let's look what's going on here. What are our swap dealers doing? They are decreasing their position. So there's a little battle going on here. Certainly speculators could drive prices higher, but they got to chop through a lot of selling before prices could go much higher. So in order for natural gas prices to really go higher, we need to see one of two things. Either that our speculators' long positions catch up with our swap dealers, or our swap dealers have lowered their position to a very neutral or maybe right around here around 0, and that could be a sign of a new strong uptrend. But in the meantime, what we're really kind of seeing here in natural gas is these two uptrends, this one that is previously and this one that's going on, are really trends of weakness. Okay. So let's go out of the physical world and go into the financial world. So here I'm in the traders of financial futures, and let's look at indexes. You know, our S&P, our NASDAQ, our Dow. And here's the NASDAQ 100. And I wanted to show you that on January 4th, notice that we have a 52-week low, an extreme position, a negative 32 in our dealer intermediaries. Again, those are our large Wall Street type banks. So our Wall Streeters are telling us what? They're getting short. They're telling us that they believe that the price of the NASDAQ is relatively too high. Now let's look what they did. They maintained that short position over 3 weeks. And then on the week of February 1st, they went from being short to being long. So between January 25th and February 1st, it went from being short 30,000 contracts to being long 25,000 contracts. In other words, they bought 55,000 contracts. Could this be significant? Could this be the beginning of a new trend? That's what the Commitment of Traders report will allow us to figure out. If I go to the chart, again, I'm going to make this more granulated. This is a weekly chart. I want to break this down so you can see daily activity. Here is that January 4th date where our large Wall Street banks had the largest short position they had had in 52 weeks. Prices of the markets went down. Matter of fact, this was really close to all-time high. Prices of the market went down, and then what did they start doing? They started buying back their shorts and starting to get long. So here we see that activity, that they were buying a dip, buying back their shorts and getting long. Now, again, the report comes out on Friday. It's reflective of the previous week's price action. So before we could even react to this would be the following Monday. So again, this is not a timing tool. I'm not going to be able to buy this dip with them. But in this case, this now becomes a very significant low for us. Think about this. Wall Streeters have already told us that these prices are relatively low because they've gone long. And you can see that we did see a test just recently, early in the week, where we came back into this level where they were accumulating length, and prices are now back out. What we can take from this now is, if we're seeing a new uptrend, what will we want to see in the Commitment of Traders report on this Friday? We will want to see that either our Wall Street banks are continuing to add to their long position, or one of the other groups, maybe our leveraged funds, start adding to their position, strengthening this trend. If prices do not hold these significant levels, then that could be also a warning sign that we are starting a new leg to the downside. So if you're a bull to the market, you want to see the Commitment of Traders report on Friday, and you want to see one of our groups increasing their long position. If you're a bear to the market, now you know where the line in the sand is. We need price to break below this significant low before we can feel comfortable being short the market. Now, if I go back to our weekly chart, and let me kind of make this really wide for you so you can see what I'm saying. What are most of our traders' positions doing, right? They are decreasing, falling open interest, weakened trend. So what price action we've seen in the last 3 or 4 weeks, maybe this little dip bottom, might be a weak trend. And we can only say what could happen in the future. Again, if we believe that we're going to see a strengthening trend, we would really like to see these positions starting to increase, either increase to the short side or one of them increasing to the upside. And that would be kind of how we could look at the commitment of traders report in financial markets, which are kind of, again, blurred. All right. So where are we at? Oh, we're right on time. Good. Okay, so I see a lot of questions that have popped up. So give me a second here. Gene has put through to me. I want to make sure I can try to answer as many as I can. Any particular ones that are kind of a theme, Gene?
Well, John, why don't you review the questions I've sent through to you? The one thing I do want to point out for everybody that is watching today, the reports that John is showing you right now that show the net positions and so on, those are available for you to view, but if you want to look at the charts, you do have to be a registered member of the bar chart website. Whether you have a free account or a premier account makes no difference, but in order to look at the charts and analyze them that way, just sign up for a free membership and you'll be able to get there. As far as viewing the COT on a chart, John's on the full chart page right now, you can either set up a template like John has right there. He's got his COT disaggregated template set up that automatically adds those two studies. Or you can just add them, by selecting them through the study button up on top. That's about all I wanted to point out. Okay.
Okay, cool. All right, awesome. So I get a question here, a couple questions. It looks like I've answered most of them. First of all, what market participants from Richard asked for indexes. So again, Richard, every market participant is different. Again, I would just concentrate on looking to see if they have an exaggeration of a position or an elevated position, or like we just saw on the NASDAQ where they flip from being short to long in a very short period of time. I think it doesn't matter which group it is. Obviously, when you talk about physical markets, there is this battle between speculators and commercials. So both of them will go ahead and have influence on your markets. So Diego asked what kind of participants go into the non-reportable. It's kind of a catch-all, but mostly it's retail traders. I've actually reached out to the CFTC, and the answer they gave me I wasn't really kind of happy with. They always say something like, well, every trader is based on a case by case, but it's basically how do they use futures markets? Are they speculating or are they hedging? For instance, like a ETF, a leverage ETF, you would think that that would be a speculator, but according to the CFTC, they're actually saying that they, because they're using futures to hedge, they would fall into the commercial category. So it's depends. But for most non-reportables, it's just the retail traders, the smaller traders. So Ellen asks, how do you know when new money has been added to the TIF indices? So that's a great question. Remember, rising open interest is a commitment of money, regardless if it's a long or a short position. So new money comes in as open interest rises. So Ron asked, can you give some insight into oil? So Ron, yeah, I kind of left a little bit of time see if we could go to oil. So hang in there. We'll look at that because there is a very unique situation going in the oil market right now. So Ron, we'll see if we can get to that. So there's a question here about why are non-commercial positions opposite to commercial positions instead of trading together? That's a great question. Remember, open interest takes two parties, a buyer and a seller. Now, a commercial trader who might be selling a uptrending market, remember, they're in that business. So they might be selling futures to hedge their position. Well, what position are they hedging? They're long the physical market. So commercials and non-commercials are always on the opposite side because they are on the opposite side of the trade. Doesn't mean that commercials are short or want prices are going down. Just means that they already long the physical. In other words, they're long crude oil. They have to hedge to protect themselves from prices going down. That's why you'll see that discrepancy between them. So the comment here was adding to short positions doesn't mean that prices are going to go down until it's overextended. Yes, Alan, that's exactly what I'm saying. A rising open interest is a strengthening trend, right? Again, that could mean that our soybean commercial traders are already long soybeans. They're just hedging as prices go higher and higher. When prices get too high and their positions get very large to that extreme, then they're also telling us that prices are probably ready to change. That's one of the benefits of using the commitment traders, looking at our commercial traders from a larger perspective. All right, let me see. There's a couple more here. So James asked a really good question here. He asks, why are not most small traders on the wrong side? Well, actually, James, if you did a historical analysis, you will find that small traders are usually on the wrong side. They usually buy after prices go up and sell after prices go down. So David asks, regarding financials, do we look at the opposite directions, are comparing the dealers versus leverage funds? Yeah, I think that would be a good analysis. Again, we want to look for those inflection points when where they go from long to short, or when we look for extremes. David asks, is the commitment traders only for the front month? No, David, is spread over all the months in our markets. Now, for financials, for instance, the indexes, a lot of those of you who trade those futures contracts know that most of the volume in open interest is in the front month. But when you start looking at the oil market or you're looking at the grains markets, there's multiple months that are trading open interest. Now, I didn't have time to talk about spreads, but one of the ways we can use the commitment to traders report, if you see rising open interest and the commitment traders report confirms that for you in terms of a strengthening trend, what you can do is, for my spread traders out here, and this should make sense to you, is look at what months the open interest is rising in. And what we would see, for instance, in that example with the natural gas, as our swap dealers were adding to their long positions, they weren't adding to the front months at that time, which was in the summertime, the September or October contracts. They were actually buying the December, Novembers, the Januaries, Februaries, and March contracts. So that, again, in terms of a probability, I could spread or buy those particular months and sell other months. So that's a great question there, David. So yeah, it's not just the 1 month, it's all months. Okay. All right, so I do have a little bit of time before we finish up here. So, and I really didn't want to go in here, but since I do have some time, which is kind of interesting, and again, under my energy markets, again, here's our commercials, producers, processors. And you can see that in crude oil, as of February 8th, we are at a historically high long position. Now, normally, if I saw this category having a large position, I would assume that prices were relatively low because our market makers are not our market makers, but our commercials know that prices are cheap. But in this case, I think there might be another story here. And that story might be that the producers or processors of crude oil have already been short or already hedged and maybe have now started to lift their hedges. Or what I believe is that those end users, commercial end users, are trying to secure or buying insurance in case of something happening. In other words, if we do see an escalation in the conflict between Russia and Ukraine, or there's some things that are going on in the Middle East with Libya, Iran, and other things, they're trying to secure or mitigate their risk to the upside. So I think what we're seeing here is a large, long open interest position among our commercials on those end users, our airlines, our transportation companies, our freight companies, and our refiners who need to make sure that they have enough supply of crude oil in order to keep their facilities running. And so again, if I go to the chart and I look at that disaggregated report, and remember I said to you that a lot of times in some markets, some of our participants' positions never really change. You can see that our swap dealers always maintain a negative or short position, but we do see that our commercials here are adding to went from a short position. Again, I think more hedging had been done in crude oil prices when we were in the 70s and 80s by our Conocos or our Exxons of the world. And that now what they're doing is they're lifting their hedges. That's kind of what's driving prices up. And we're just starting to see some long positions. Now, notice the last time we had some long positions, we were at relatively low prices. So we're getting kind of mixed signals here in terms of crude oil. If we get above $100, it'd be interesting to see what happens with these positions. Notice that our speculators, this blue line, actually, as we got up around $85, they started liquidating some of their positions. And actually, if we think about their whole position over the last 6 months or so, they actually have lower positions. So, this last leg is kind of a weakened trend. But we do see these commercial traders that are now getting long. Again, I think this is more of a hedging aspect of our end users who are trying to protect themselves to the risk of price to the upside. If I think that this crude oil prices are going to get above $100, then what do I want to see? I want to see that commercial red line continuing to add to that position, or in what we're starting to see in a very short period of time here is our speculators starting to add to their long positions. Okay, great. Let me just check and see if there's any more questions.
John, there's been a number of people who've asked about currencies and Forex with the Commitment of Traders report. And I know that this webinar, you're really focusing on futures, but I do want you to maybe point out in our currencies menu. So going up to, nope. Yeah, currencies. There are specific sections there for Commitment of Traders charts on the currency cross rates. So if you do have something specific, a question about these COT charts and COT reports, please email our support group. They'll be able to help you. That's support@barchart.com.
Exactly, and I want to point out that there is a difference between the Forex cross pairs that multiple cross pairs that you can trade in the Forex market. And when we talk about the Commitment of Traders report in these cross pairs, notice that they're all based against, except for just the one here, they're all based against the US dollars. And these are really futures Forex contracts. So they're a little bit different than what you would know from, let's say, a Forex market, okay? So it's just, you can still use it as kind of the same way that I explained to you in our physicals and our financials, but I just want to realize that there is some nuances in here in terms of the difference between what a Forex trade is and a Forex futures trade, okay? So good question there, Gene. All right, so we are right here towards the top of the hour, and let's do one more segment here. So how can we apply? Well, we talked about we want to look for those primary groups that are driving our trend. An example we looked at in the natural gas, that flow of smart money in and out of our markets. That was the example that we used with the Qs, flow of weak money, right? That was the second part of that natural gas. So what are some of the takeaways that we can have for the Commitment of Traders report, and see if this old dinosaur is giving you that information? So first of all, is that, again, the Commitment of Traders report is not a timing tool. Remember, it's reflective of what happened on Tuesday. It doesn't come out on Friday, and by the time you can react to it is the following Monday. But what it is, it helps us to look at open interest. We can look at open interest on a daily basis, and I see a rise of open interest throughout the last week, and then I get the Commitment of Traders report, and I can go inside and say, oh, my market's open interest is rising because this market participant is adding to their position or increasing their position or decreasing their position. The other thing we can look at is that rising and falling open interest is a good indication of a strengthened or weakened trend as our traders increase their positions or decrease their positions. We're going to look for those transitions from going from long to short. These are significant levels. These are significant inflection points in price, especially if it's one of our larger participants. And this could be the beginning of a new trend. Remember the example we had with natural gas. Where was that inflection point? Right there. Where was the beginning of our trend? Right there. Very crucial in terms of using the Commitment of Traders report. Using that probability to start looking only for trades that line up with that probability, that trend. And again, finally, concentrating on these 52-week lows and highs in our positions as warning signs that our trends may be reversing. So again, if we think about the crude oil example I just showed you, right? A large position, 52-week high, could that be a sign that crude oil prices are about to fall? Maybe, even though we have a commercial that is adding to that position. And that's the final takeaway I want you to understand, is that even commercials sometimes get it wrong. Now, I don't know what's going to happen with crude oil, but if we believe in the Commitment of Traders report, it's telling us that something is happening. Something is going to happen in a very short period of time. Okay, so I hope you guys enjoyed this session today. I know this is a kind of a complex subject matter for those of us who are futures traders, but again, try to apply this to some of your trading. Look for those probabilities, look for those trends, look for those inflection points to have an opportunities for your trading. So I know Gene's going to ask me to do this before
I
we
thought you were
finish.
going to forget.
I'm not. So next week, well, actually not next week, but in 2 weeks, we're going to do a segment on swing trading. Now, somewhere between long-term investing and day trading, we'll find swing trading. And what we're going to look at is kind of how to dissect swing trading, or what is it really about? What we're trying to do is capture very small pieces of momentum or small pieces of trend on a very well-designed trade, right? Pre-designed trade. And we're going to take profits when our market gets to our targets. We're not going to hang around. Maybe our trades will only be a couple days in length. A lot of swing traders will open up positions in the beginning of the week and they'll close them on Friday. So if no matter what happens in the market, they're out of the market by Friday, so they don't want that weekend risk. So we'll look at how swing trading works. We'll look at how to decipher momentum using our stock screeners and our strength and direction indicators. And I'll give you some simple rules in terms of risk management to help you decide if this is a good trade or one that maybe I want to pass on. Now, we're not going to have a session next week, but I do want to encourage you that if some of you might not be aware of, we do have a YouTube channel that we are starting to create content, and there might be, or maybe not, might be some new content popping up between now and our swing trading session.
That's good for this week.
Okay, well, thanks so much, Gene, for helping me out for another great session. And I want to wish everyone out there, be safe out there, the best of health, and the good of all trading.